Cintas announced their first quarter 2024 earnings, and in this video I'm going to look that up and do a little bit of research and talk a little bit about Cintas's earnings results. Over the last year, they're up about 28%. The S&P 500 is up 22%, so Cintas is outperforming the rest of the market. Just to talk a little bit about how Cintas actually makes money, their business model is pretty straightforward. Cintas makes money selling and renting boring but necessary items like cleaning supplies, fire protection products, and uniforms. Cintas also offers a growing fire protection service. And although the company is boring, there's a legendary investor named Peter Lynch who has often said in the past that companies that do something boring are usually good companies to invest in. Cintas has about 1 million customers across North America, and their rental business accounts for 77% of their revenue. The total market for uniform rentals in North America is $16 billion, and of that, Cintas sits ahead of all of their competitors with a market share of 25%, or approximately $4 billion. Its three largest competitors are Aramark, UniFirst, and G&K Services, and when you combine all three of their competitors, they only account for 20% of the total market. So Cintas alone accounts for a larger percentage of the uniform rental market in North America than the next three of their largest competitors combined. The superior market share, size, and scale of Cintas is important in this industry because product differentiation between uniforms, cleaning supplies, and first aid kits is minimal. Obviously, there's really not going to be much difference between how you manufacture a uniform. It's just an article of clothing. So the competitive edge is obtained by securing locations and routes for route-based service organizations like fire departments and hospitals. And because of the massive size and scale of Cintas in this market compared to their competitors, Cintas has the edge in this area. Right here we can see a little article that touched on the fact that Cintas recently acquired a rental uniform service in North Carolina, a family-based service built company that delivers outstanding quality and service to their customers, which has generated tremendous customer satisfaction and retention. So obviously this ties into their business model, which is mainly just expansion and acquiring a bunch of their smaller competitors to increase their footprint across North America. Right here we can see their income statement. Cintas reported revenue of $2.3 billion in the first quarter for 2024, which is also the third quarter for 2023 for the calendar year. And we can see that that is up about 8% from $2.1 billion. Their net income of $385 million is up from $351 million year over year. So that's an increase of 9.5%. And then if we scroll down here, we can also see that their free cash flow for the period ending August 30th, 2023, increased, or didn't increase, but it stayed about the same at around $230 million, even though their capital expenditures increased by $30 million. So they were able to invest more into property, plant, and equipment, but because of the increase in their operating cash flow from $300 million to $330 million, their free cash flow stayed about the same. So they invested more, but they were still able to stay just as liquid, which is obviously a really positive sign for their company. Then if we scroll down here to page 6, we can see their balance sheet. Their total assets came out to $8.7 billion, up from $8.5 billion in the prior period. And then we can see retained earnings increased from $9.5 billion to almost $10 billion, which means that they now have more cash to redistribute to shareholders through stock buybacks and also through paying out dividends. Lastly, for cash flow for operating activities, as we saw before, it increased by $30 million. And right here we can see for dividends paid, they paid about $117 million of dividends, which is up from only $97 million year over year. So they've increased their dividend payout, but we can see the repurchase of common stock declined pretty sharply from $320 million to $73 million. So they're still returning value back to shareholders, but this year they prioritized dividends more than repurchases of common stock. And if you include the two line items, it looks like they returned less value to shareholders this year than they did last year. So now we can see this discounted cash flow model to figure out the intrinsic value per share for Cintas. Their growth rate over the last 5 years from their free cash flow, which was about $790 million in 2018 and $1.3 billion in 2022, came out to be about 9.9% per year compounded annually for the last 5 years. So I'm using that as the projection for the next 5 years. I cut that in half to 4.9% for the next 5 years after that, so we could project their cash flows for the next 10 years in total. The weighted average cost of capital metric I'm using to calculate the discount rate to discount their future cash flows to their present value is a little under 7%. I got that from this weighted average cost of capital calculation right here. Basically took the book value of their equity and debt, which we saw from their balance sheet earlier, their interest rate, cost of debt, which was 3.6%, and then to calculate their cost of equity, I took their tax rate for their most recent full year, 20%, the current 10-year treasury yield, which is 3.9%, their beta value, which calculates the volatility of their stock compared to the rest of the market, which is 1.27, so they're a little bit more volatile than the rest of the market, and then the average stock market return, which is 10%. We can see if I take the risk-free return, add that to their beta, and then multiply that by the market rate minus their risk-free return, we get 11% for their cost of equity, 3% for cost of debt. If we multiply that by the proportion of their debt to equity on their balance sheet, we get a weighted average cost of capital of 6.87% to calculate the discount rate for the cash flow model. We can see if we take all their cash on their balance sheet and subtract their debt, comes out to a net debt position of $2.7 billion. So they do have more debt on their balance sheet than cash, and they currently have a little over 100 million shares outstanding, which means their intrinsic value per share comes out to be around $216 per share, which means that at the current share price, they are currently not trading below intrinsic value per share. They're actually trading at about double the estimated intrinsic value per share based on these discounted cash flow metrics. Then right here, I did an analysis to compare them to two of their main competitors, as I touched on earlier, Aramark and UniFirst. We can see that across the board, it looks like Cintas is definitely performing a lot better than their competitors, which is to be expected because, as I touched on before with their business model, they do hold the majority market share in this industry. 47% gross profit margin, 15% net profit margin, 15% return on assets, and 37% return on equity. We can also see that their debt to equity ratio is 0.69. They have the highest PE ratio at 42 times earnings. So it could mean that investors are projecting more growth for Cintas than their competitors, or it could mean that their company stock is currently overvalued. And then lastly, we can see dividend per share is about $4.60 per share with a dividend yield of about 1%. So basically, for every $100 you invest into Cintas, you're receiving about 97 cents per year in dividends, which isn't really that good. But as we saw, most of the return for investors that invest in Cintas doesn't really come from dividend. It mainly comes from their stock growth, as we've seen right here. So the dividend is more just an add-on to the stock growth. And lastly, we can see I'm comparing Cintas to the other companies that I've made videos about prior to this one. In terms of ranking companies based on their estimated intrinsic value per share compared to their share price, Cintas doesn't make it onto this list because they weren't even trading below intrinsic value per share. You can see the list of companies right here that were Occidental Petroleum, ExxonMobil, AMD, ConocoPhillips, Chevron, Google, Alibaba, Albertsons, Adobe, and Kroger. Next, we can see in terms of growth rate, Cintas had an estimated 9.9% growth rate, which isn't good enough to get them onto this table. AMD had the highest at 83%. In terms of dividend yield, 0.97% isn't high enough to get onto this list. Intel had the highest at 5.52%. We can see that for profit margins, Cintas had about a 40% gross profit margin and about a 15% net profit margin, which isn't good enough to get them onto either table. Adobe had the highest gross profit at 86% compared to all the companies we've looked at, and Oxy had the highest net profit at 36%. In terms of companies we've ranked so far for third quarter revenue and earnings growth, Cintas comes in at third for both at 8% revenue growth and 9.5% earnings growth. Adobe had the highest revenue growth so far year over year for Q3 at 10%, and Oracle had the highest earnings growth at 60%. We can see right here, these were the results for Q2, and I just have this table here so that once we've finished out all of the Q3 earnings results, we'll be able to see if there are any companies that ranked high for Q2 and Q3, which could maybe suggest that that's a company that's pretty consistent in terms of outperforming the rest of the market. Then lastly, for stock performance, Cintas does make it onto the table at 8th place with a 236% return over the last 5 years. Tesla had the highest at 1,100% return over the last 5 years. So let me know in the comment section down below what you guys think of Cintas. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.